Excessive debt is a risk that we are always watching out for at GHPIA. It's a factor we analyze when determining the growth potential of individual stocks, using several metrics to gauge the threat debt poses to an investment's future value. But debt is also a risk we monitor in the economy at large. As we noted in our video about the 2008 financial crisis, excessive leverage throughout the real estate market offered early warnings about the collapse. When the COVID pandemic hit in 2020, there were fears that private debt would again cause a financial crisis, especially with many businesses shuttered and rising unemployment. But many of the cornerstones of the economy and the financial system entered the pandemic in much healthier shape in terms of debt than they were in 2008. Households were carrying much less debt as a percentage of their disposable income. Corporations also held much less debt relative to their equity market value. And banks had sufficiently built up their capital cushions in preparation for liquidity emergencies. Even state and local government debt had stabilized and begun to shrink. The one area that remained worrisome was federal government debt. Even before the pandemic, public debt as a percentage of gross domestic product had begun to approach levels not seen since World War II. To help bridge the economy through the devastation of the pandemic, the U.S. government added about $5 trillion to already high levels of public debt. In fact, there's even a formerly unorthodox economic philosophy called modern monetary theory that is becoming more mainstream. MMT dangerously argues that radically increasing the national debt isn't problematic as long as inflation and interest rates remain subdued. Nonetheless, interest rates likely won't stay near all-time lows forever, and taxpayers will have to pay back the extra trillions spent in 2020 eventually. As wealth managers, that's where we see potential risk over the next decade and beyond. Debt-minded investors are watching for tax increases and government spending cuts, both of which could slow the economy. There is also risk of inflation. Even more dangerous scenarios involve defaulting on debt and weakening our currency as a result. Does this mean a collapse is imminent? Not necessarily. As the wealthiest country in the world, with the dollar still maintaining its prominence as the world currency reserve, the U.S. has advantages beyond all other countries in shouldering higher debt. Further, as interest rates have remained low for over a decade, the interest expense burden from the national debt is manageable relative to prior periods, such as the late 1980s. The much healthier levels of private debt held by households, corporations, and banks helped the economy remain resilient as it navigated the pandemic. We will maintain a close watch on the national debt so that we can keep client portfolios resilient as well.